Welcome back. Blue Apron cooking up an IPO. The meal kit delivery service filed preliminary documents last night to go public, according to the Wall Street Journal. The company reportedly intends to trade on the New York Stock Exchange under their ticker symbol APRN for Apron. And in 2015, Blue Apron was valued at roughly $2 billion. Valuation has gone up since then, that's for sure. Joining us right now, Lead Edge Capital founding partner, Mitchell Green. Mitchell, good to see you. Thanks so much for joining us.
Thank you.
Will you invest in Blue Apron, or are you already an investor in Blue Apron?
We are not an investor in Blue Apron. We will look at Blue Apron because we do a lot of IPO investing. Actually, my prior firm, Bessemer Venture Partners, Bob Goodman and Kent Bennett, led the seed investment in it. So, congrats to them. It's a good business.
So tell me where you invest in terms of IPOs and software in general. How do you make the decision to allocate capital in these software companies?
Yeah, so look, we are looking for rapidly growing businesses that have decent amounts of capital efficiency. There's been a huge amount of companies with just incredible burn rates, that where consumer churn is very high, or in the consumer space or in enterprise space. We're looking to invest in companies in really big markets that are, so a lot around companies doing things in mobile, a lot around companies doing things in cloud. There's this company, Tintry, going public. That's a cloud company as well.
Well, you just talked about the giant cash burn, and Uber has been one that's been notorious for that. But they were able to go out in the markets and raise money on the debt side. I thought that was fascinating. But do you think these companies need to go public sooner? And does the Spotify rule impact that? And just so viewers know, the Spotify rule is a direct listing on the New York Stock Exchange and not going through an IPO process. Just so people are aware.
So we are small investors actually in Spotify as well. And I think if Spotify goes well, you actually might see more of it. As an investor in Spotify, we love the idea of a direct listing. You don't have share dilution to existing shareholders. In terms of, do I think the company should go public? So look, we invested in Alibaba years ago. The company was, a private company for like 14 years.
Yeah, let's show a list of your investments. You said Alibaba, Uber, Marketo.
Marketo was a public company, got taken private by Vista. MindBody, which is a public company. Look, I think if companies continue to generate value and continue to grow, it is totally fine being a private company. But what can happen is, if the growth rates slow down, which is inevitable as companies get larger, if your growth rate slows down, your multiples just massively compress.
Do you think that, because we were talking about Blue Apron, and that's kind of a food delivery company, but there are a lot of these direct-to-consumer businesses. We had one of the founders of Casper Mattress on. Whether you're looking at linens as a huge area, is this space getting crowded, do you think? And in terms of how the valuations look among these?
So yeah, those are two different questions. So it's interesting. So I was up meeting a company yesterday called Knixwear. It is in the women's intimates apparel space. There's a bunch of companies going there. Casper. It's funny. 20 years ago, all these companies would have distributed to Bloomingdale's, Nordstrom's, Neiman Marcus. Now they've just said, hey, let's just build consumer businesses. Let's go direct to the consumer effectively. The challenge is, a lot of these companies are not tech companies. That doesn't make them bad businesses at all. They're consumer businesses.
But they sell themselves as tech companies.
Exactly.
They want the tech valuation.
And consumer businesses trade on multiples of EBITDA at the end of the day. And so for us, it's been challenging to invest in the consumer product space effectively for what it is, just because the valuations are crazy.
What do you make of all these valuations spiking within the FANG stocks, Facebook, Amazon, as well as Netflix?
Yeah, look, I used to work for one of the Tiger Cubs under Julian Robertson. Look, they're great businesses. Amazon is a phenomenal business. Netflix is a very good business. You can argue them.
But are the valuations excessive?
They're not cheap, and they're very crowded. They're owned by every hedge fund on the planet.
Growth at a reasonable price. They're actually cheaper compared on that metric than consumer staples.
That's true.
So why wouldn't you go in there? That's why you see their performance.
And there's no reason to think that just because they're expensive, they're not going to get more expensive.
I'm sorry, Microsoft pays more in their dividend than the 10-year Treasury, and it's going faster than the U.S. government. So where am I going to park my money?
That's true. So the way we invest in IPOs and public stocks, because we own some things, is we take a 10-year view. And we basically are like, in 10 years, what is this thing going to earn? Put a reasonable multiple on it, and just back into it from an IRR perspective.
And you think that Blue Apron is not just a trend? I mean, obviously there's a lot of competition, but you believe in 10 years it's still going to be
haven't done the work on it yet. Do not know. We have had the opportunities to invest in it as a private company and looked at it. We did not. Look, I was an idiot. I should have invested when it was a $20 million business.
Yeah, sure.
I did not. But look, I also thought Amazon was expensive at $500. Shame on, it was waiting for a pullback.
Well, it's just hit 1,000, Mitch. There you go. This is great. Really good stuff. Thanks so much, Mitchell.
Thanks for having me.
Great to have you on the program today. Please come back soon. Mitchell Green there. Come